Right at this point in time. Okay, so last time one of my analyses is simply here. And let's see. Pictures. I save the file. Let's see if I can find it. Just bear with me for 1 second. And that's not the one. Here's the charts. Pictures. And there it is. Should see it right now. Right. Can you see the photo? No, not yet, right? It's still black. So that's not the one. It is this one. So when I do trade, as much as possible, I take snapshots of the trades that I do or what I analyze, just to also have a copy for myself. Not only that, it is also good for me to see whether if my forecasting was correct or not. So, but nevertheless, this was the chart, and as you can see, secondary trend line basically got broken. And then from there is that strong area demand, but the major ones is done here within this green shaded area. But there is a boundary between this uptrend line and the area of demand. So the odds and probability it will come back through here is highly probable. However, the issue was the analysis was done way before the price basically got closed. And congratulations, Marty, you're the only person actually who emailed me, who emailed me that gave the right answer. There are, in regards to technical analysis, one advantage of technical analysis is that every price will be stamped based on the time frame, from all the way from the lowest time frame from a tick chart all the way to the highest time frame of a monthly chart, even a yearly chart for that matter. The major time frame that I use is mainly the daily time frame. Everything below, lower than that is simply a micro component of the daily time frame. And then on the weekly time frame, it is imperative, or at the end of the week, it's actually imperative to analyze the weekly chart. At the end of the month, it is imperative to analyze the monthly chart to see the overview viewpoint of the direction or the what we call the energy flow of price that creates basically trends. So with that being said, let me share a whiteboard.
Ray, can you hear me?
Yes, I can.
Can I get your meeting ID number so I can connect to my iPad?
Yeah, sure. Absolutely. Just bear with me. Let me find it for you. Okay, the meeting ID is 187
Uh-huh.
104
Uh-huh.
333.
Okay. Thank you.
Okay, no problem. Okay, in every chart, regardless whether you're using bar chart or candlesticks, there's always going to be base and price. There is an opening price. A high price will be established, will be time-stamped within a particular time. Remember, there's only two components in a chart. It's basically time and price. And then a low price will be established, and then a closing price will be established. Or vice versa. It doesn't matter which price actually will hit first. Sometimes they either hit the high first or sometimes we hit the low first, depending actually whether if it's a bullish candle or a bearish candle. And then this time, the price will be time-stamped for as small as a tick chart, 1 minute, all the way to a monthly time frame. Okay, so open, high, low, close. If it's a bullish candle, then it will create an open, low first, high, and then close. If it is a bearish candle, then it will have an open, a high, a low, and then a close. But the sequence between opening and closing will always be the same. It cannot be closing and then opening, then between low or high. It has to be opening and then closing. Okay, so that's the sequence of what it can do. Depending as well on the time, sometimes, it will go up and down and uncertain. Sometimes the opening is the same as the closing price. So the question now is, who are these people that create the opening price, the high price, the low price, and the closing price? Opening price points is always going to be a combination of amateurs and professionals. Hence, that's why they have what we call open outcry. If you look at CNBC, right, if you watch news, there is sometimes on the futures price, there's going to be like a net price or something like that. So they're calculating the average price of where the opening price is going to open. Sometimes, say, the Dow or the S&P will say minus 20 or plus 20. And hence, if, say, it closed at, say, 20,880, and you're seeing minus 20, then by the time it opens up, it's around 20,860. So from the closing, that's why there's a gap of 20. And then they will fill that gap. That's why if you're day trading, you know exactly approximately how much it will get filled, then you can make at least 10 points to fill that gap. So it's just a little trading technique. So, but nevertheless, these three price points, high, low, and close, are institutional price points. Institutions. It cannot be you, it cannot be me. So in other words, everything you see fit, the highs, the lows, and the closing price, especially the high and the lows are very important because they're institutional ones. So if you can see, for us, when I do teach, I have the peaks and troughs to draw trend lines objectively. See, in the past, I mean, if you observe, if you go to meetup groups, if you go through trading workshops and seminars, like what I did in the past, they will teach you, okay, if you draw your trend line, connect them as much as you can, you like that. And to realize this is very subjective. Because I did that one experiment in the office, or actually the office was mega full, it was like 22 people actually were standing. And then I did a very simple exercise. Can you guys demonstrate to draw your trend lines? So 10 people, basically, I just chose 10 people to go at the front and to draw their trend lines. And guess what? There's 10 different ways of people drew their trend lines. That's very subjective. And I'm like, wow, okay. So I said to myself, well, I didn't blame him because I used to be one of them. And then I said to myself, I learned from one guy, actually, really good NASDAQ trader. He was a scalper when scalping was still very huge because it was in fractions. And then when I also learned from guys who used to trade in CME, basically futures traders and also stock traders. And then I went to one workshop where we spoke about pure objectivity. To be objective is simply to really read and to know what the market is basically telling you. And hence, it finally clicked. The lesson was not for newbies, not for novices, mainly for advanced traders, because actually at the beginning, like, whoa, it was way beyond other people's way of actually understanding, because it also involved certain physics and mainly the science behind it. And I'm like, dang, this is exactly this is why when I teach the advanced class for method number 1, there's a science behind technical analysis, because everything is through energy. When there's energy, there is vibration. When there's vibration, there's frequency. So you don't see it. This is a 2-dimensional chart, but it vibrates up and down, up and down. This is on a daily time frame. So this is vibrating based on the weekly and based on the monthly, and hence that's where you can see the oscillation of the frequency going up and down based on the daily time frame. So if we will change the time frame all the way down to 1 minute, you will see a lot of noise. It's like plucking a guitar, right? And you can see there's a lot of noise. Why? Because it's a 1 minute time frame is the minuscule energy vibration of a bigger time frame, like a daily time frame. That's why every time frame will vary depending on what you're looking for. This way the intention of trading is very important. Okay, but nevertheless, going back to where I am, what I'm talking about is that when you, okay, actually, let me share, go back to the whiteboard. So to identify trends and to draw your trend lines objectively is by defining what an uptrend and a downtrend. If an uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower highs and lower lows, they are now highly objective. Meaning you can't make things up. You can't just say that an uptrend is a lower high and higher low. No, they're a series. A series means it's a sequence of higher highs and higher lows, likewise for lower highs and lower lows. Therefore, if that would be the case, then when you're also drawing out your trend lines, then you need to know, that's why I know exactly when someone's novice and I know exactly when someone's a professional. If they will draw their trend line very meticulously using the lows and they know exactly where to draw them, if an uptrend dictates a series of higher lows and a series of higher highs, and they're connecting the higher lows, that is pure objectivity right there. Hence is why trend lines have hierarchy. We have like a primary uptrend, secondary, tertiary, because every trend line will be touched, will be tested by certain price points in the future. It's like an auction house, right? If you've been to a real estate auction, you will know exactly that, say, for example, if the last price of the property is $1.25 million, there's no way that the same price will be sold at 1.25. It's pretty much unlikely. Either it will be 1,240, 1,200, or 1,600, 2,600, right? So there's a plus or minus. And it's very seldom that it's going to be even unless 1.25 has been established 10 years ago. That's why forecasting, in terms of being a technical analyst, every price point is very important. It's where you see a lot of lines. So people are like, how can we have a lot of lines in there? All those lines are very important because there are institutional price points. And if there's confluence means that the prices are very close to each other, then they are a very significant area of where either sellers will be resisting price points or buyers will be supporting price points. Okay, so those are the things that are very important for me anyway, and when I'm teaching my students. That's why every trend lines, when they're drawing trend lines, everybody's very objective. And we don't make things up. Like this one, for example, notice all the lows. It is hitting even the opening, closing price. They're almost very accurate to where it's at. And we don't make it up. So that being said, if closing price and opening price points are institutional price, and when I analyzed, the price was here, the closing price was on this side, but there was still around 2 to 3 hours for the price to actually finish. 2 to 3 hours is a lot of time. Why? Because within the 2 to 3 hours, and the market is open, there are a lot of news that's still bound to happen. Plus, not only that, globally, people are tracking news all over the world. So anything can happen in Syria, and it can happen in Pakistan, anything can happen in Europe. And if there's some form of explosion or natural disaster, the price will be affected. And all of nowhere, Trump can say something stupid, and bam, it will come back down and go back up again. So, or Powell can say, who's the new chairman of the Feds, can say anything out of nowhere, and it will affect the price. So, like closing price is an important element, and the reason is because here, from the low all the way to the top, imagine the amount of demand that got basically put into place in order for the S&P's price to close at above 2664. This is a very significant area of demand. And how do I know that? Every time it drops, it goes back up. Every time it drops, it goes back up. Every time it goes down, it goes back up. Even this one, there's a lot of force to the downside. When there's something too much force, imagine a lot of selling pressure. Hence, the continuation of the force, and all of a sudden it rebounded. Make it this way. When there's a lot of force to the downside, what happens to price? Well, first, let's establish between supply versus demand. When there's force to the downside, then that means that there's more, supply is greater than demand. When supply is greater than demand, then price will drop. But just imagine the amount of energy, the amount of power for price to be pushed where there's a lot of foundation. It's like a floor with a thick cement. Imagine the amount of energy in order for that to break. And then yet again, at the very end, imagine, I just want you to imagine the force on how price went back up in the demand area. That's a lot of force. So if you combine these two candles together, there's a push and pull. So here's a good example. You should be able to see my, turn on the light so you can be able to see it. Put your hands together, one pushing down, one pushing up. So if you're pushing down way heavier, and then you push it up with your bottom hand, and then there's two equal forces. See, there's force pushing up, force pushing down. So when there's two equal forces, at one point, something or somebody has to give up. In this particular case, the resistance. That's why it's called support and resistance. So people who trade and they use just simply the terminology support and resistance, I know that they are not professional traders. I know that they are novice. Because even if I ask them, what does it mean? And if they don't know, that means that they're just learning for the sake of learning what they read or what they know, what they learned from somebody else. So support and resistance simply means that when support is when buyers are supporting price points. See, look, do this. Then out of nowhere, when there's no more supply, when there's no sellers, see, it goes, the price will automatically have to go up. Likewise, if there's a lot of selling pressure and there's a lot of force, a lot of resistance, see, they're resisting. Force is pushing to the upside by buyers. Sellers are resisting price points. Hence the terminology resistance, but it's just purely basic economics of supply and demand between buying and selling. When there's too many sellers resisting price, and then demand disappears, a buyer will disappear, guess what happens to the price? It will drop, guaranteed, right? You see the difference? That's why when I'm teaching, I'm going back to the basics, the basic foundation of economics, basic foundation of supply and demand, the basic foundation between buying and selling. That's why on the beginner level, we do not use any indicators. Why? Because they need to learn the difference between buying and selling, defining the measurement of force between candles, between buying and selling, that dictates the price, whether to go up or down. That also creates the energy flow of price, which is now trends. So if you can see here, let me stop the video, so because it's being recorded. That's why here, when uncertainty candle happens, only two forces will create some form of a decision-making process. And one of them has to make a choice. Either sellers will disappear, and in this particular case, look at that. Buyers took over. And who's in control? Sellers, meaning that when there's no selling, sellers will have the power to dictate in terms of what price they can sell it at the highest price as much as possible when there's demand. At the same time, there's too much demand from there. because sellers disappeared. So here, on the other hand, has a strong error of supply, meaning there's a lot of resistance of sellers resisting price points at this level. And how do we know that? Well, notice there's a lot of force over there. Over here, though, stabilized itself. They're unsure whether they go up or down. It came out, got rejected, bam. Notice a lot of force. They tried to push it back up, uncertain, got rejected, all the way back down here. So for the first time it broke out, second time, third time it got tested, fourth time it wanted to, didn't want to, so it broke out within this secondary downtrend, but the closing price closed below it. Another time got rejected, came back up. See this area right here is what we call a void. When there's a void and there's energy being trapped, that's like an explosion. When there's explosiveness, when there's tight air, if you know physics, that's why explosions or explosives is because of trapped air. When there's trapped air, molecules become too tight, and then when it starts to expand, it becomes heated up. It will explode either to the upside or to the downside. Very similar when it comes to trading. Notice there is an increase in volume. So when there's the transacted area, they don't know where to go from this point, but they need to make a choice. And then out of nowhere, it exploded to the upside. Notice this is why the strong area of supply got broken, got penetrated, and it went through this major supply, especially this high. This high is the price to beat. Therefore, when now you have this, higher low, then the next sequence, the only thing that it has to do is to break through a breakout to create a higher high. Once a high has been established, you'll see higher low, higher high, higher low, higher high. That will create basically the trend to retest this major supply right there at 2,800. If no one's willing to go beyond that, and you'll see a clear cut of the lower high, then we're going to start of a new bear market. And this is where we're going to start shorting. Okay, so that's the idea of trends based on pure price. So the mistake was, or is why in future reference, when you're analyzing a trade or when you're analyzing a chart, do not assume, never anticipate. Anticipation is expectation. When you're expecting, it's very subjective because you're now you're analyzing based on your own perception. When you are using your own perception, then you just want to choose to see what you want to see, and you're no longer seeing based on the perspective of the markets. 100% you will lose. Okay, that's why for us, we don't trade based on price patterns. Price patterns are very subjective because you're just expecting that, hey, look, there is a bullish engulfing. Hey, look, there is a morning star. Hey, look, there's an evening star. Doesn't necessarily mean just because it's an evening star that is going to reverse. No, they're just also what we call correctional patterns. Okay, so when you have correctional patterns, like say this one, you have a morning star pattern. Part of your anticipation for pattern traders is that it's going to go to the upside. This is just simply purely a correctional pattern to go to the downside. This one, totally different. You also need to know which one's which that will be more powerful. Like this one is also a morning star. but it's a correctional pattern to go to the downside. But if you know how to read price, then those patterns are very powerful if you know how to read price. Okay, so that being said, the lesson is this. Always wait for the closing price to finish when you're analyzing a chart. This can establish the amount of force, the direction of price, and if the closing price closed here and say this is a bearish candle, easy, price will head back to this side. And then when this happens, you can change now then your analysis. Damn, okay, now back to the demand area, back to the original forecast that the price will go to 26.94, which it did, breaking out now to the 27.21, 27.35. Next price point to beat or to test is this one, but they will take time in order to get there. You'll have a correction, another higher low, continuation. So part of the forecast now is that the probability it will head back down over here is May 18 before we'll head back over there again, because trend lines are also being used as a form of support and resistance, like this one, for example. Just an example, perfect example through there. Like this downtrending line is also as a form of a resistance before it broke out. Okay, this is a resistance level, broke out. Very important trend line right there, which they did break yesterday. This is basically a free ride. The market can do what it ever wants to do now from here on forwards. In other words, you're definitely very bullish. You can't go short. Okay. With the resistance of this is a major supply level, but the major supply is this one. Okay. And that being said, since this is for the end of the week, you can see on a breakout from there. So hence the odds and probability of continuation of the buyers to the upside is highly probable. This correction is perhaps finished. Why? Because on the monthly time frame also shows a very good strong correction, higher low, next one either higher high or lower high. All right, so that's how you can dictate from the hierarchy of time frames from a bigger time frame to a smaller time frame too. See, for up to 2 days of very bullish, but however, 1, 2, 3, 4, 5, 6, 7 days, 1 week. 1 week right there, stabilizing itself from a point of stability. Correction is going to happen before a continuation. Okay, so short term, very short term, correction, medium term, continuation, longer term, still continuation until it hits 28.76 area. Any questions? Does that make sense right there, Marty?
Yes, it does. Can you hear me?
Oh, now we can hear you. Yes.
Oh, okay, yes, absolutely.
Excellent. Good. So, but your answer is definitely correct. The mirror, you can't type it in, but does that make sense? Likewise for Winzy. But nevertheless, Winzy, we're going to discuss more of this in class. All right. That's connected with that is now the VIX. Notice there's no fear. There's a lot of security, a lot of certainty. That's why the market keeps going up and the volatility index is basically dropping. So once it hits probably another 12, in actual fact, it's now in the demand as well. It's pretty much time that this is going to head back up to where that means that the S&P has to correct itself, which also is in conjunction with the Dow. Dow is basically just a little bit more ahead in terms of breaking out rather than the S&P, but also a bunch of higher lows right there. It's very similar. Even on a monthly time frame, you're in a correctional mode right there. So the odds to go to 26,699, 26,700 is highly probable. No one goes beyond that. And you watch, once you have, after maybe 2 or 3 months, if all of a sudden you see a doji, and then you have a bearish candle, and this is where we're going to start basically shorting really hard, okay? Meaning you are in a space where you can make money really, really fast to the downside. So it doesn't matter if you buy an ETF or you buy an option. This is where we're waiting on, actually. Okay. So that's within the S&P. The dollar index, finally though, it's in a correctional mode too. And at this point, let's go back to the weekly for a second. Love it. So hence, if it finishes like this, notice you have a lot of buying pressure somewhere along, not until Wednesday, and then yesterday and today basically dropped back to the same price point of the opening. Selling pressure for candlestick traders is what we call a gravestone doji, which is a very strong candle. But the odds and probability that this is going to come back down as a form to correct itself is highly probable. So that being said, you were in a space, and if I see a lower high, it will come back all the way back to 91.78. So we're also, that's why oil and gold, in actual fact, there's divergence. It doesn't add up. Oil and mainly crude oil and Brent oil are at least a day behind the dollar index. So hence, we're bearish with oil for now, created new highs. Likewise for Brent oil, same thing. Crude oil is a little bit more faster paced than Brent oil. Gold just stabilizing itself based from yesterday's bullish. So I'm also bullish with gold, likewise for copper. Just stabilizing itself. I believe there's more room for this to head back up to the upside. The 30-year yield, it's a delayed time. Okay, this is a little bit more accurate. Same thing, right? It's saying it's also down, which is in the same. Actually, there's a big gap that's stabilizing itself. The yield is a little bit more advanced than the dollar index because they have to go hand in hand. So the bond market is up, yield is down. Okay, so I look for the connectivity of the macro fundamentals. This now means then that euro is currently, we went heavy with euro for the past 2 days. Currently it's just correcting itself before continuation to the upside. So it's finishing like this, level demand, the chances of it heading back up to correct is highly probable. So we started going long 2 days ago, got in more yesterday. We're holding some positions and then holding it till around 120.47. So that's approximately another 110 pips all the way to 180, 250. Okay, so that's the idea is to hold this more in about another week or two. So nothing to let me go through 4-hour time frame there. Yeah, so part of the empty space before a continuation. We love breakouts. This part of the breakout, we have what we call a royal flush strategy. A royal flush is simply basically you're guaranteed. I mean, there's no guarantees. I'll say it the other way. It's basically certain that you're going to make money because of 100% probability, but no guarantees because of the future or anything can happen. However, if the target points are a little bit more tighter, then it's definitely 100% that you're going to make money. So royal flush strategies, once they come in and they're if you're very selective, your win to lose ratio is actually very high, likewise for your reward to risk ratio. Okay, so these are strategies that we basically, I do teach basically in class. All right, method, we have two different methodologies from an advance where we're almost an institutional price point. And then this is method 2 when we have divergence based on an extra indicator. When something's way oversold and you have a very bullish candle and it meets the criteria, then this is where we buy more and we ride it until, to make it very objective for us, we use fibs to create target price points rather than using supply price points. Supply is very more subjective because you can create your own target point, but if I'm teaching in class, I use fibs to be objective. So there's 3 different target points from there. Right, so there's nothing, that's with the euro. Let's go through the pound quickly. Pound is consolidating, they're waiting for some form of news. We're gonna stay away from that. Dollar yen, from yesterday's, basically is to have an opportunity to go short. It did, but not as much as we wanted, so basically taking the money and basically run from there. Nothing for 4 hours. By Sunday, we have a potential entry point to short. So that's why I'm getting excited by the first end of Sunday, Monday. So nothing for the dollar yen, dollar Swiss. Nothing for the dollar Swiss. It was really a good one to short it based on the shorter term time frame, but it's over. About 99.97 from here actually. 60, I mean 75, 7 even you say you want 50 to 70 pips, that's actually pretty good. So nothing for now. Aussie was another good trade. Have an entry point, another entry point to go long. We entered here, second time yesterday, there's another one today. T1 got hit based on method 1. So we entered around 74.40 actually, 126 pips. And entry point yesterday, all the way there, there's another 79, 126. 4 hours, nothing. Dollar CAD was a good trade a couple of days ago for shorting. It reached almost 130. The CAD became strong because of news, and then actually dropped massively, 180, 200 pips. So currently now in a correctional mode, there's a chance, an opportunity to go long right there. So there's an entry to go long with the dollar CAD. Highest probability wing at 39 pips right there, 71. Or another 100 pips to the upside. Okay, so there's the dollar CAD, an opportunity with dollar CAD to go long. Kiwi was a trade. This was based on the change of rates. Actually didn't have any change at all, but they said something, and then but during the conference it came back up. So currently holding, stabilizing itself right at this point in time. Let's look at the weekly for a second. Week is still very bearish, but back to demand there. And so there's an opportunity as a form of correction. We'll stay away from that for now, just holding the positions. We spoke about the euro. Euro yen. Euro yen is also pretty strong, but still back to the downside. Actually, it's currently pretty weak. Okay, let's look at daily here for a sec. Yeah, bearish with the euro against the yen. Let's look at the weekly. I think the weekly is pretty weak right there, yeah. However, in the demand area, holding the price. There's a potential from a forceful candle to the upside. Potentially can come back at 132.20, but 180 pips to the upside. Pound yen. Pound yen has more chances of winning. So this is a good one. Demand area. We go to the daily. Bingo. Okay, nice. So this is a good one to go long. 4 hours. There's almost an entry point, but not quite. So by Monday or Tuesday, we'll have entry to go along with the pound for people who like confirmation. Aussie yen. Once again, Japanese yen has an entry to go along today, so this is a good one too. 4 hours, it already started through here actually. So nothing, pretty much just a continuation. And then look at the weekly time frame for a sec. Yeah. The chances that this is going to head back out to 84 is more than likely to happen. That's very bullish, so which is good. Consolidation. So there could be, yeah, some form of heading around the 85. CAD yen. Still bearish because you have a lower low over there. Oh, sorry, this is the monthly, the month. So there's uncertainty with the CAD yen. You have a higher high, you have a lower low. So then you need to make a decision whether if this will come back down, but because you have a lower low, you need a higher low before it can continue to go to the upside. Let's look at the daily here for a sec. Yeah, so once it creates another higher low over here, then we can go long, but other than that, nothing. 4 hours, it's saying to go short. This is a good one. We're shorting, bottom to top. Created a new lower high, new lower low, 85.22, 84.97. These are two high probability they will drop down to about 46, 47 pips. Okay, so that's basically it. The major trades, I mean, the euro against the dollar to go long. Pound yen is a good probability. CAD yen is a good probability to short. Dollar Swiss, same thing for shorting, but that needs to wait for about a day or two. And then with the S&P, like I said, I'm still very bullish. Dollar index, I'm bearish. As for the rest of the markets, I believe gold can have more room to go back up. Oil is currently, in my opinion, I'm bearish with oil. It's lagging at this point in time. Okie dokes. Any questions, Marty, Winzy, Demir?
Yes, I do have question.
Yes.
Can you hear me? Yes, yes.
Loud and clear.
So you're using tradingview.com to go to the all the charting?
I like to use TradingView for the indices and stuff. So
For analysis, for like a moving average, Fibonacci, right? I see you're having those.
This one is by FXCM.
FXCM.
Yes.
Okay.
For me, to analyze my currency trades is I use FXCM, and then I execute using Awanda or Forex.com. And then for futures, I use TD Ameritrade. I think or swing because there's futures there with options.
So tradingview.com, you are using it for what then? I can
Just
see a lot of
trading views for analysis because they are free. It's
okay.
Yeah, you can also use TradingView for currencies. They're also pretty good. If you want to use TradingView, that's more than good enough. If you don't want to open up FXN as a demo.
Okay.
Excellent. Marty, do you have any questions? Demir? If you don't have any questions, then you guys enjoy your weekend, and we'll see you sometime next week.
Excellent.
Enjoy.
No, I understood what you were saying. And
I'm sorry, Marty. Couldn't hear you there.
no, I appreciate that. Thank you very much for sharing. And likewise, have a great week.
Likewise. Thank you. Bye, guys.
Take care.
Yep. Thank you. Bye-bye.
Thank you. Bye.